Hello, chart watchers, and welcome to this Friday, May 31st, 2019 Market Watchers live show with your hosts, Tom Bowley and Mary Ellen McGonigal. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Taking a look at market action today. Well, another round of tariffs, this time with Mexico. The market not reacting very favorably to that news, and literally global markets not reacting very well, to be quite honest. But the Dow Jones, you can see, just a month or so ago, a little bit more than a month ago, was up probably about 1,700 points higher than our low today. We were down another 230 points currently. The S&P 500 down 24. The NASDAQ down 72. The Russell 2000 down 13. 10-year Treasury yield also declining, which suggests more and more money rotating into the defensive Treasury market. Volatility index on the rise, but certainly quite a bit off of its earlier high, which was up near 20. It is back to 1823. We have seen the overall market, the various indexes bounce off of those earlier lows today, and you can see the volatility index declining as a result. Leaders today, the clear leader is real estate. A lot of these real estate firms liking the fact that we are seeing lower interest rates for a number of different reasons. Obviously, it's easier to finance projects, but also many of these real estate companies carry nice yields. So you have income investors looking for more income than what these treasuries are currently yielding. So real estate benefiting, also utilities benefit for the same reason. But even though not exactly flying on utilities relative to what the overall market is doing, you can see that utilities showing some relative leadership today. To the downside, though, we've got consumer staples continuing to fall. The last week or so has been pretty rough in this space. Communication services also moving to new lows today, breaking below the mid-May lows. That's not a good sign. Among the industry groups, auto parts. Look at this decline since the market topped back toward the end of April. This has just been a very, very steady move to the downside. Tariffs certainly having an impact here. 110 points on this index from 490. That's a big drop, more than 20% here in this group in the last month. Distillers and vintners also taking a big hit today, and really this week. This is the group that held up pretty well until the beginning of this week, and you can see it's just not been very good for the distillers. Among companies reporting earnings last night and or this morning, actually all of these I believe reported last night, but Okta, you can see OKTA, huge move up. This is one we've talked about a lot on the show. It's a software company. It's been one of the relative leaders, and we see why. They came out with a very strong earnings report. Great reaction. Super move to the upside there. VMware, this one surprised me a little bit, although there was some selling, some pretty heavy selling the last 2 or 3 days as we headed into the earnings report. A lot of indecision today, and you can tell that when you get these long tails to the upside and downside. About a $7 range today on VMware. So got buyers and sellers battling it out today, but clearly not good overall news as the stock's down $11.50. And then finally, Gap, just another one of these retailers that continuing to come through with not so good results, not so good outlooks. And you can see Gap down more than 10%, almost 11%. Well, first of all, Mary Ellen, welcome back. Always great to have you on here on Fridays. How are you doing?
I'm doing quite well, yes. Happy Friday.
Yeah, and I'm going to give you your props right here at the very beginning, because a week ago we had a poll when you were on here, and we said, okay, here are some big earnings reports that are coming out this week, and we polled the audience on what they thought, would be some of the better reports. Which ones would you be most comfortable, or which one would you be most comfortable holding into earnings? And your pick was Dollar General. And
that's right.
Yeah, it's had a great week. I'll pull that chart up in just a little bit when I move on into some of the technical news. But Dollar General's had a great bounce. I went with Ulta. Ulta came out last night. It has actually recovered quite a bit off the earlier low today, but Ulta was not nearly as solid coming off of its earnings as Dollar General was. But Viva Systems, we talked about this. I think we both like Viva Systems.
Yes. That one was spectacular. Viva Systems, and still going strong today. And
yes, and I believe, if my memory serves me correct, that last week's poll, those were the two at the bottom, Dollar General.
Yes. We were talking about that, the reverse indicator.
Yeah.
But I think, yeah, with Dollar General, it was all about the lowered expectations. The valuation was low going into earnings, and those are the only types of names that seem to be surviving. Of course, they need to come through with good numbers, but they were not priced for perfection.
No. And they came out with a pretty perfect report, a pretty good one. But anyhow, we're going to get into that again in a couple minutes. Let's go ahead and move through our schedule, upcoming schedule. Rick Bensenor will be joining us next Tuesday. Or actually, Rick Bensenor will be joining. Yeah, he'll be joining us Tuesday. Greg Schnell's coming in on Monday. That's going to be that was kind of a last minute change. But Greg is going to be joining us on Market Watchers Live on Monday, so that'll be fun. And then, of course, later in the week, we'll have Jesse Felder, and I'll have a workshop coming up the following week. But today, it is what's hot, what's not. We always do this on Friday, so that'll be a lot of fun. We'll get into the 10 in 10, Salesforce.com. Very interesting chart. Check that one out and see if you agree with me when I go over that one later. And then we're going to wrap up the show today with some June seasonality. So let's just jump in. We've got a lot of economic and earnings reports, so let's start with the economic reports. And the first one out today was the April personal income and spending, and you can see both numbers came in better than expected. May Chicago PMI better than expected, and May consumer sentiment a little bit below expectations, but not a bad reading. So this market is not trading off of economic reports for the most part. It is trading off of fears, mostly trade-related fears. But if we take a look at the 10-year Treasury yield and what's going on in that market, this is a 3-year chart. And again, I stopped doing the short-term chart because we've broken down, so I really wanted to take a look at some of the longer term, maybe more intermediate to long-term levels, support levels that we should be watching for on the 10-year Treasury yield. September of 2017, we got down to a low, which was about 2.04%. And it seems to me like we are on a fast track right back to that level. If that doesn't hold, that could be bad news for the 10-year Treasury yield moving to the downside. In other words, more and more money could be rotating into the treasuries at that point. And anytime you've got a lot of money rotating into defensive areas or safe areas, that's normally not a good sign for the stock market, because the stock market, you have to be willing to take on some risk there. As far as earnings news goes today and last night, a number of pretty good sized companies came out, and a couple of these were on the report or on the poll from last Friday. But we had Costco come out. They beat expectations. VMware beat. Dell Technologies beat. Ulta beat. Marvell beat. Okta beat. Zscaler beat. Gap missed. So we had a chance for a full slate of beats, but Gap ruined it. Taking a look at some of the charts, and let me pull up the first one I want to take a look at, which is actually, before I get into any of these, I do want to bring up that Dollar General chart and just show you what was going on there. So let's start with that one. All right, here we go. So Dollar General, here was that big gap up. And like I said earlier, Mary Ellen, you called this one. This was a really nice reaction to the earnings report. And I think what you had said was, that this had pulled back and maybe gave you a little bit better feeling going into that earnings report. And it certainly was the correct call.
Gave it more room. And then also these guys are apparently well positioned. They've been moving away from China so that they're not quite as exposed to any potential tariff damages.
Yep. Well, that's a good thing in this market for sure. But if you look at the relative strength, this is a stock that about 2.5 months ago started turning up. Had been a leader back at the end of 2018, pulled back a little bit relative to the specialty retail group. But keep in mind, specialty retail has been a pretty nice, solid area of the market. So going along for the ride, or over the last couple of months, slightly outperforming a strong group, nothing wrong with that. And you can see the overall group has been sliding in May, while Dollar General breaks out to a new high. So you got a nice relative performer here in Dollar General. I think that was a great call, Mary Ellen, and I just wanted to point that breakout out to everybody. That in this kind of a market environment, if you got a stock breaking out to a new 52-week high, you've got a pretty good stock you might want to think about hanging on to. Some other stocks, though, that I did want to go over that I just talked about on the earnings slide. Costco. So Costco here is below its 50-day. Its 20-day now is coming down and about to get a death cross below. Anytime you get a short-term moving average crossing beneath a longer term moving average. That is a death cross. It's just telling us that momentum clearly has started to turn. Doesn't mean that the end is near and that Costco is going down to $100. It just means that for now, the bears are in control here. You can see we have not had a hollow candle for the last 7 days. Hollow candles mean you close above the open. Filled candles mean you close below the open. So what we're seeing here is not just gap down, but also selling throughout the day on a net basis. I think today is going to be pretty big for Costco, because if we start to see selling again later this afternoon with another red filled candle with big volume, already 2 million shares traded today, breaking below the early May low, I think that could set up some additional selling on Costco. So this is one we certainly want to keep an eye on. VMware. VMware, you can see the volume picked up the last few days. Of course, the overall market's been selling off, but it's begun to lose its relative strength to the software group. And with today's gap down, I think I'd want to try to keep a fairly tight stop here, because there are just too many other software options to be in a stock that is no longer leading on a relative basis. I think this is an area that I would watch. We put in a top in March right at about this 177 area. We held it on a pullback at the end of March after we had broken out. And now here we are again with heavy volume. I would not want to lose this area of price support. I think there's already technical damage, and that would begin to add even more. So let's go ahead with the next one, which is Dell Technologies. This is DELL, and they actually came out with a really nice report on the bottom line, but they showed that they were being impacted by China, and that is not what the market wanted to hear. And so the stock on 4 million shares already today, it's a very, very heavy volume day, has gapped down, and all of a sudden that relative strength that the stock was enjoying, no more. I would be careful with the stock until it begins to show strength. We had prior support at 64. The 50-day is near 64. We gapped down below it on heavy volume. I don't think I would be interested in this stock until it showed to me that it can get back up through that 64 area. And I think that's going to be a difficult call. ULTA, Ulta Beauty. It's a little bit of a beauty after where it was earlier today, but it's still not exactly a beauty. It did hold gap support from back in March. We saw the big gap up on heavy volume in March with earnings. We are, at this point, at least holding that. But I think the key levels are going to be this gap support just above 310, and then the declining 20-day. We're seeing more and more of these death crosses with the 20-day coming down below the 50-day. And I think one of the key signals going forward is, can these stocks move back up above their declining 20-day moving average? If they do, then I think it starts to look more like a trendless consolidation period. That's where you see a lot of moves up and, above and below moving averages. Moving averages don't give you a whole lot of support and or resistance in a trendless market. And that can be a good thing from a bull market perspective. Move up, sideways consolidate. That's great. If you fail at 20-day tests, though, and go back down and print new lows, that begins to look like a downtrend, much more of a downtrend. So I think this is going to be really important as we go forward. Okta, got to bring this one up. OKTA, this was very similar to Viva. Nice relative winner in the software space, and they delivered again. Overall, software has been going down, but on a relative basis, software is still a great area of the market. And if you can get one of the leaders like Viva Systems or like OKTA, those are the types of stocks that I would want to be looking at. Let's see. We'll do two more real quick. Zscaler is down today on heavy volume, trying to hold its 50-day moving average, which has been a big level in 2019. That's where we've been holding. Let's see if we can do that. But this is also in the software space, another stock that's been a pretty good relative performer. So I'd like to see it hold its key technical level. And then the last one, let me just go ahead and pull up Gap GPS. Big gap down, heavy volume, hollow candle, and then recovery so far. But look at what's going on here with this group, apparel retailers. Relative to the S&P 500, there's not that many areas that are worse than the apparel retail group. And when you look at Gap relative to the apparel retailers, just a week ago, prior to its earnings report, it was at a relative low. So you got one of the worst stocks in one of the worst areas. You shouldn't be expecting too much out of these earnings reports. And you can see Gap, although it is maybe putting in some type of an exhaustive reversal here, maybe it's an exhaustive gap, We'll have to wait and see whether that's the case. I do think that Gap is one that I'd continue to avoid in this area in general. All right, upgrades, downgrades, Mary Ellen, what you got?
You bet. We are going to go ahead and start with an apparel-related stock that came out with numbers that really disappointed. The stock plummeted, but analysts came in fact, Goldman Sachs came in and upgraded. This is Canada Goose. The stock was a big winner last year, the darling among the apparel names, had a tough go with earnings here. Here's this big gap down recently, 2 days ago on earnings, and the upgrade really is not helping the stock. It's down 3% today, and you can see that your indicators are all quite negative. The stock currently is oversold. That's when your RSI gets down below that 30 level. It's now at about 25. So this stock really is DOA. Let's take a look at another stock that got upgraded, and this is in the consumer staple space, Kraft Heinz, and another lowered valuation type of a play where analysts are thinking that it may have gotten overdone to the downside, but again, not really helping the stock. We can see this big gap down, earnings related. The company's been trying to restructure, but with no luck. This is another stock that is just very much in a downtrend. When you see these simple moving averages all trending downward, that is going to make any type of potential downtrend reversal really quite difficult. And we can see stocks can remain in this oversold period for quite some time. So just because it's down there doesn't mean that the stock is going to go up. Molina Healthcare, MOH, this stock is responding quite nicely. It's up 3% on an upgrade. We are seeing a little more traction in some of these medical healthcare stocks. RSI is positive, MACD just poised to turn positive. So this actually looks quite bullish in an otherwise difficult market. We can take a look at Sina. This is a China software stock that got upgraded, another low valuation, trying to bottom fish here. Stock's really not responding. All of your indicators are really quite negative. Let's take a look at a semiconductor stock that got upgraded today. This is STM, and we can see that the stock is responding. We're going to get into some more in the way of these semiconductors, but your RSI and your MACD are still quite negative. We talked about those downward trending simple moving averages being quite negative. Uber was upgraded today. A lot of talk here about the potential viable ongoing, the lack of competition, and the thought that this stock could do well. Let's see if I can pull up LYFT. It's not on the list, but this is Lyft, another recent rideshare IPO, which was also upgraded, but this one's responding quite a bit better. It's up 5.5%. JP Morgan is expecting 50% upside to the stock from here. So of those two, certainly LYFT is very interesting. Let's take a look at downgrades. And the first name that we can look at is in the REITs, CTRE. This is Care Trust, has been a very big winner year to date. And we can see that the stock initially did break below this 50-day simple moving average. On that downgrade, your RSI is trending negatively, and you're having that negative black line through the red on that MACD. But if it's able to close above that 50-day, the stock should do okay, or certainly be able to hang in there. Now on the downgrade side, we can get into another retailer, JILL is the ticker symbol. These guys have really had a lot of problems. You can see this big gap down here on earnings. They've had inventory issues, sales issues, and so forth. And analysts are continuing to downgrade it despite this gap down. The stock's down 7.5% today, and all of your indicators certainly pointing toward potential more in the way of downside. And Mallinckrodt, this is a medical pharmaceutical stock. And this is another one that they continue to come out with very, very poor prognoses, management guiding lower. We can see that despite being oversold, everything is pointing downward for this particular stock that was downgraded today. The next name is a software stock that just came out with numbers. They missed on the revenue side. We can see this gap down. The stock is down 15% today, and management is guiding lower as far as earnings and sales going forward. RSI, everything in this stock also trending downward and pointing to more downside. We can take a look quickly here at NUE, in line with any number of the steel stocks, all tariff related. These guys were downgraded yet again further as the prognoses and outlook remains quite negative. Last stock that we can take a look at that was downgraded today is PACCAR, PCAR. And this is an area that Tom pointed out as far as auto supply, and it was downgraded. Today, there's talk about auto supply and the Mexican tariffs being impacted here, but we can see the RSI is negative, MACD now down below zero, and your death cross, the short term down through the longer term. So we can go ahead and move on next to what's hot and what's not. Believe it or not, despite a difficult environment, there are some areas that are actually hot this week.
Yeah, we've had, a little bit of mixture. I mean, obviously the market overall has had a rough week with all the tariff talk and, more and more folks coming out on the recession bandwagon saying this is going to cause a recession in the U.S. and around the globe. But, there are still pockets of strength in the market. So I'll go ahead and let you get started there, Mary Ellen, with what you have.
You bet. Okay, so the first name that we're going to be taking a look at, and actually it's an area of the market, and this is Cypress Semiconductor. But before I do that, I am going to go ahead and pull up the semiconductor index, and let's see if we can do that, because what I want to do is show you really just how decimated this particular area and this group has gotten, all mostly primarily tariff related, but also outlook related, because a number of these areas or a number of these stocks actually came out with earnings and the prognosis really wasn't quite as strong as we would like. So we're looking initially at an intraday view. We can see that the index is mostly flat daily, but as we drill down further to the weekly view, you can see really just how damaged this semiconductor area has gotten. So that is providing you with a bit in the way of overview. But from here, what we can do is take a look at some of the stocks that are up within the semiconductor grouping this week. So the first name we're looking at is Cypress, and we can see this big gap up here. And the company, actually, this is all about a Bloomberg article that came out. They may be a possible buyout candidate. So subsequent to that article, Morgan Stanley upgraded the stock, and we can see it's advancing even further today. So the stock, let me just go ahead and pull up this chart a little bit so you can get a better view here. It is breaking out now, albeit it is more of a V-shaped base, but as the stock breaks out of this base to new highs, take a look at that volume. So there really seems to be traction in the potential buyout story, and it does appear to have a bit more potential upside. Another semiconductor stock, this is SMI, and this one does not get quite as much volume. And you can see that the stock price is at about $6, but net, it is trending upward in an otherwise down area of the broader market. Your RSI is positive. MACD is also trending upward. Let's take a look at another semiconductor stock that is a bellwether name. This is Advanced Micro, AMD. The stock had a pop here because they announced that they have new chip products for gaming and PC, a very big area for this particular company. So overall, when we see semiconductor stocks, they're actually 15% of the technology index is comprised of these semis, and semiconductors really provide those chips for the new technology that is sprouting out everywhere. So we want to see strength in this area. It's very refreshing to see a potential bounce. This is BRKS. This is a smaller Brooks PRI company. Here's this big gap up here on earnings. Stock pulled back not only with the markets, but also with the semiconductor group. And you like to see stocks as they pull back to their 50-day simple moving average. That's this red line here. And then potentially form the right side of a base that would confirm that this near-term downtrend is now behind us. The stock broke up above that 10-day simple moving average. This is bullish. RSI just maintaining positive up above this dashed net neutral, where the MACD, while it had this negative crossover, it still remains above that zero. So if we were certainly in a healthier market environment, I would tell you all in with BRKS, but it does look bullish here. XLNX is Xilinx. This is a big 5G semiconductor play. Stock came out, they disappointed on earnings, and it has really been decimated, if you will, very, very much. It was down 14% here on the gap and subsequently down quite a bit more. Seemingly finding support at an upward trending 200-day simple moving average. That's this red line here that is constructive, and we can see that it is trying to reverse this downtrend, and that would be quite bullish for the stock. Let's see, software. I have time to go over. I believe Tom did already review Viva. They came in ahead of estimates, very constructive, gapped up. It's adding to that. Here's another smaller software stock, Pro Holdings, and these guys announced last week ahead of estimates, guided higher, very bullish. You would not know what was going on in the rest of the broader markets to take a look at that. And then one other area that I can take a look at very quickly, we're going to look at a company that announced earnings this week, but it's more to point you toward an area of the broader markets. This is Heiko. They are in the aerospace defense. Gap up here, strong earnings, management guided higher, and it's continuing to power to new highs. Take a look at that huge volume. MACD and RSI are positive, and I'm going to go ahead and turn it over to Tom.
Okay, sounds good. I'm going to go ahead and take a look at a few areas of the market that have somehow managed to avoid the wrath of the sellers. So not exactly, some of these charts aren't exactly bullish, but they are at least holding up. The first one is the Dow Jones U.S. Toys Index. I've talked about this quite a bit, even on a longer chart. I'm going to stretch this out to a year. But if we take a longer view, you can see that this 850 level, and I think it was when I had Bruce Fraser on here, I mentioned this chart to him, and he did like the consolidation and all. But we're waiting to see if we get this breakout above this 850 level, where we just haven't, every time we get up there, the sellers come back in. Well, now we're back down closer to an area of support. But toys this week were higher fractionally. And one of the stocks I think that's worth pointing out is Zynga. Zynga continues to trend higher. This is one, you could look at the volume trends, very, very strong. I think if there's one stock within that toy space, I would say it's Zynga that I would be interested in. The pullbacks here have been holding that rising 20-day moving average beautifully. I think this is one that looks like it wants to go higher. Some other areas of the market, I want to bring up the restaurants and bars. Now, this group actually looks pretty good. Toys has been in a downtrend, just kind of consolidating. Restaurants and bars have been outperforming. This has been a good area of the market. And think about how hard we've been hit in May. And yet the group, after printing a negative divergence, higher prices, lower PPO, went back to its 50-day moving average and trying to bounce off of it. Daily PPO still above the center line. So I think that the restaurant and bar group looks good. So what has been working there? Well, DIN. This is Dine Brands Global. Nice move here this week. It is holding its support after gapping up back in February, went all the way back down to about 82.5. Set a support level there. I think if we can get through 95, that's a double top here in April. A breakthrough 95 would be very bullish. I think DIN looks good. And then Denny's, DENN, also trying to make a breakout here. Given what the market's been going through, this doesn't look bad at all to me. Let's move on to the gold miners. With all the money that's been moving out of the U.S. stock market, all the fear that's been building, kind of makes sense that gold miners, they tend to do well when the overall market is fearful. Check out what happened in the fourth quarter of last year when the market was weak. And now with the market being weak in May, we're seeing that money rotate back into the group. I'm still a little concerned longer term because of the U.S. dollar and the fact I think the dollar is strengthening. But this has clearly been one of the most impressive areas of the market this past week. A couple of individual stocks in this space. GFI, big breakout above $4.40. Look at that volume coming in. So even though the overall group's not breaking out, here's one that is within the space. So I always like to see relative leaders. AEM, after trending lower here for the last couple of months, I think yesterday and today, really good action. Volume picking up today. Certainly a big winner this past week. And the last one I have is FNV, which is Franco-Nevada. Also sideways consolidating, trying to make a breakout. A close back up above about $79 would be very bullish for FNV. So those are the types of stocks. If I was going to get into gold mining, I'd want some of the relative leaders. And I think those three were at least a couple to consider. All right, we're going to move now into the what's not hot. And we could have our pick here. There's been a lot going on. I talked about a couple of the areas earlier today, the auto parts that was getting hit, the distillers getting hit today, having big down days. But I'm going to go with the durable household products this week. This is a group that has definitely taken it on the chin the whole month of May. It was trying to make a breakout. I actually wrote about this group in my blog. You might want to go back and check that out. But when it looked like we were making this breakout, notice the ultimate low down here. The reaction high was back to 240. We could not get through 240. We got to 238 and now have moved back lower. And the relative chart, if you go back the last couple of years, this has been a dismal part of the market. So now that it's rolling back over again, I would be especially careful with this group. So which stocks might you avoid? Tupperware. No doubt about Tupperware, big gap down, heavy volume. You get back up to the bottom of this gap resistance and could not get through and just kept selling off. I don't see anything yet on this chart. Really, the only thing I see here is just a matador, just letting the prices continue to fall. What is this, like 10, 12 days in a row? Maybe one up day. It's just been a brutal stock. You want to stay away from Tupperware, at least for now. Newell Brands, MWL, another one that gapped down back in February. We saw a little bit of strength coming in May and quickly right back down to a new low. When you get this kind of move, if you do chase and you get in, you think, okay, this is a turn. When you get a stock like this starting to roll back over again, I think that is a good sign that tells you just to get out. So Newell Brands, I think, also weak here. And then finally in this space, Whirlpool. Whirlpool, big move down, another one that's breaking down. The group's not good. The stock's not good. You want to stay away. In the footwear space, just another minute here or so. Footwear, you can see breaking down below this double bottom. That is not good. Failure at the 20-day. This is what I was talking about with the overall market. If we fail at the 20 and break to new lows, that is not what you want to be involved in. Certainly not on the long side. One big reason for it was Nike. Nike breaks this double bottom as well. Volume picks up. Failure at the 20-day. PPO moving to new lows. These are signals of a downtrending stock in a downtrending area of the market. Personally, I would stay away. If I was going to do anything with footwear, I did want to just pull up one other stock, Deckers. This is on a relative basis, a stock that I think looks better. It gapped up, pulled back into that 137, 138 range. We've held that. We've now put a double top in. At least we're consolidating here. PPO at the center line. If I had to find something in footwear, it would be Deckers. Mary Ellen, I know you've got a bunch for what's not hot. What do you have?
I do, yes. Unfortunately, given the current market dynamics, we are going to have a lot on the what's not hot side of things. I'm going to go ahead and start out by showing everyone the Dow Jones Transportation Index. Take a look at the hit that this index has gotten. It is adding on to last week's woes. A lot of this has to do with the severe storms that are taking place across the Midwest. Not only is it devastating, unfortunately, a lot of individuals and people that have been impacted, but it's really, as far as the stock market goes, it's negatively impacting a number of the transportation-related, trucking, the rail stocks, and so on as their schedules get knocked out, so to speak. We can take a look at KNX, which is a smaller trucking company, but we can see that the stock really is down. This particular stock has not really been, this is Knight Swift, was a big winner in its day, but it's been in a multi-year downtrend. But this more recent decline is all about the negative impact of the weather. We can see this RSI is negative. Stock has broken below these key simple moving averages. MACD had that negative black line through the red, but now it's below that net neutral zero. So in very poor standing there. The other name that we can look at here within trucking is Landstar. This is LSTR, another one. But really what you can see is just how damaged these stocks are with the impact of these storms as far as their ability to transport goods. We can see the RSI is negative. MACD had that negative crossover back here, now in negative territory. Another area that we can take a look at within these transports that have gotten hit, but this is not necessarily going to be weather related, but the airline stocks, we can take a look at Ryanair, which is Ireland-based European discounter, and the stock has been really declining because those discount fare wars are now turning against the company. Analysts are predicting that the earnings and revenues will continue to suffer. Southwest Air, LUV, this is all about the grounding of those Boeing airplanes that are malfunctioning. The company is not able to recover. The stock is very much in a downtrend. RSI is negative. MACD is negative. Let's go ahead and move over to another area of the markets and take a look. Tom talked about the apparel companies and how negative they're doing. But what we're looking at here is the XRT. This is the S&P Spider Retail ETF, and we can see really just how negative and in declining phase this area of the markets has been. This is despite unemployment at a low, consumer confidence at a high, but a lot of these retailers are coming out and announcing tariff-related issues as impacting. They may need to raise pricing. First name we're going to look at is Abercrombie & Fitch, ANF. The stock gapped down. This is all about earnings. Same-store sales were down. They're closing 3 of their flagship stores, has people alarmed. So we can see the stock initially started to turn negative here. We've talked about that this death cross, the shorter term 10-day green line down through the 50-day simple moving average is being quite negative. But once we break below this 200-day simple moving average on huge volume, despite you might get these little dead cat bounces, but for the most part, any kind of uptrend with Abercrombie is out the window. PVH is the next retailer that we can take a look at. And these guys are not so much retailers, actually. They are apparel manufacturers. This is all about China. We can see the stock, while it is oversold, this RSI line is below the 30. Again, all arrows and signs are pointing downward for this stock. The RSI and now your MACD is very, very negative. So really quite negative. We can take a look at one other retailer because honestly, we can spend all day taking a look at any number of retailers that have gotten negatively impacted here recently. This is Big Lots. BIG is the ticker symbol. And the stock is actually bouncing today. It's up about 5.5%. But we can see going into that this very significant downtrend. So for those of you that may want to again, bottom fish, this downtrend might be reversing. Take a look at this the MACD. It's really quite negative. We, at the very least, would need to see this black line up through the red in a positive fashion. But ultimately, you want to see that RSI up above that 0. Also with the RSI, not only is it not even close to getting to that net neutral 50, but you will want to see the RSI turning up as well before potentially turning positive. We can take a look at a couple actually consumer staple stocks. We have a few minutes here, and I wanted to point out a couple of names in the consumer staple, because normally this is an area where we would think that it is deemed defensive because of their higher yields, the fact that these are products and goods that are needed regardless of any economic strife. The first one we're looking at is Fizz. And the company is, it's called National Beverage Corp. And you can see that the stock has been in a downtrend. And one of their major products is my gosh, I can't think of the word, a fizzy bubbly It's called LaCroix, and they were super, super popular. Now the competition is really coming in and taking away their thunder. So the stock has been in a declining period. Sales and revenues are declining, and it looks poised for even more downside as competition heats up. But let's take a look at a really large name within consumer staples, and this is General Mills. And the company really was on track, doing quite well. They've expanded, they've gotten shed some of their weaker performing areas and brands, and have turned toward other areas such as the dog and pet food area. But this is all about a downgrade by Goldman Sachs, that potentially they were priced for perfection, and the stock is having a little bit of a difficult time potentially reversing from that gap down, because once a stock breaks below that 50-day simple moving average, that really is quite negative. And we can see that RSI and MACD also are really trending negatively. Take a look at this huge volume, and this is a pretty high yielder. It yields at least 3.5%. It may wedge up here over the near term, having been overdone on that gap down, but net, the stock does not look positive. We can take a look quickly at some of these. We've talked about this in the past. Tobacco, this is Philip Morris, continuing to trend downward. Their U.S. sales continue to drop. It's been the worst in years. And also, Brazil came out this week and they are suing Philip Morris for 26 different diseases that are impacting many Brazilian individuals, so that the company now has to pay huge amounts in the way of healthcare. So that lawsuit is not helping the stock. But one last one that we can look at in consumer staple is a company that is impacted by today's news as far as a potential Mexican tariff war, if you will. So this is Constellation Brands, STZ. Take a look at this gap down today, and it's all about the company imports Corona and Modelo from Mexico, and the fear is that the cost for those products is going to increase, and with that, the company, there is a potential that the stock could see further deterioration. So we can see that the stock already was in a bit of a downtrend. This gap down now really just erased any potential possible turnaround of this downtrend. So the tariff-related fears not only are China-related, but we are seeing a push out among other areas. And I wanted to take a look at one other area that is not hot this week that got hit, and it is pharmaceuticals. The first company in stock that I'm going to pull up is a bellwether. This is Johnson & Johnson. And we can see that overall healthcare stocks are the worst performers year to date. Johnson & Johnson among them. We can see this stock really has not participated in the year-to-date rally prior to May. But this gap down is because there are fears of a trial because of the opioid crisis. They are targeting J&J. Stock gap down, huge volume, and it's really having a difficult time potentially recovering from those trial fears. There are other large cap pharma names that we can look at that already have been in a declining phase. This is Mylan, MYL. So when we go back, we can really go back to June of last year. Now, of course, this is going to be bear market related, but even prior to that, once your stock breaks below, the green is your 10-day simple moving average, the red is the 50, the blue is the 200. Now we have the RSI trending negatively, the MACD back here in June, and then this decelerating downtrend continues. Any time of kind of reversal attempts are met at resistance. That's your 200-day. Once this 200-day starts trending downward, in addition to your shorter term simple moving average, that is a very confirmed downtrend. Again, your reversal attempts are met with resistance, and the stock continues to deteriorate here. Another name that we can look at that is in this medical healthcare area is a company that is another lawsuit related. This is AGN is the ticker symbol, Allergan, another one that's been in a downtrend for quite some time. But this is all about the company recalling their breast implants in Canada. There's anticipation that that will spread to the US. So the downtrend in this particular company and stock is continuing. And we can take a look. We have time to look at one other medical and healthcare related stock. And really, this is Perrigo, PRGO, another pharmaceutical company. And we can really see how these healthcare stocks have struggled. A lot of it has to do with potential headwinds in Washington as far as policy procedures going forward. But overall, a lot of these healthcare stocks are really in confirmed downtrends, and there are some bright spots out there, but certainly overall, it's been a very tough area in the markets. And Tom, I know you want to get started with your seasonality.
We're going to get into that in just a little bit, but I do want to also say, first of all, I'd mentioned earlier that the distillers were having a rough day, so it was great that you pointed out Constellation Brands. I am a little bit sad, though, Mary Ellen.
Oh, tell me, Tom.
Well,
are you a fan of Corona or yes. Modelo?
Yeah, my Coronas are going to go up by 5%, but that's only half the problem. You know what the other?
Oh dear, I don't. Is it lime? Are lime costs going up for?
Yes. You know where limes are imported from?
No. Is it
Mexico?
Oh, nuts!
So yeah, well, they're one of the top exporters of limes. I think Spain maybe as well, but yeah, it's probably useless information for everyone out there. But if you like Corona and you like to put lime in it, well, we're going to be heavily impacted by this latest tariff.
That's not good news, Tom.
No, it is not, especially as we go into the weekend. Really, could we just have saved this maybe for next week?
I think you may need to load up before those tariffs. Buy a new storage unit.
Get out there, get your Coronas.
Load up.
Probably not Corollas. Get Coronas and get your limes, and then you'll be set. But do it by June 10th. You heard it here first.
Oh my gosh.
Okay. All right. We're going to get into. We're going to start 10 in 10 here a little bit early today because I do want some extra time at the end of the show. We're going to go through the June seasonality. So let's go ahead and start it off with Salesforce.com. And I'm not a fan. You can look at it and you say, well, it's holding up pretty well, hasn't broken down. The market's weak. Why wouldn't you like this one? Well, look at the group it's in. It's in the software. So of course it's holding up because it's it's in a group that has been one of the top performers relative to the S&P 500. But if you look at Salesforce.com relative to software, it has been one of the worst performers over the last 3 or 4 months. You can see the huge volume that kicked in, the sell volume that started back in March. I don't know what Wyckofians would say about this, but to me, this is starting to look like maybe a little bit of distribution, and a breakdown below 150 would be a bad development here for Salesforce.com. So I know it's at support, but I do not like the way this stock is acting, especially given the fact that it is in a strong area of the market. So I am going to pass on Salesforce.com.
And I agree with you. I follow this as well as software very closely. The next one is MTOR, and this is a auto and truck equipment.
Yeah, I don't like the development yesterday. I was actually watching the stock to see if it could get back up through its 20-day moving average, and just not happening. You can see the $20 level is very critical support. So you want to keep an eye on that. Here was the prior high. We gapped up here with heavy volume, took out that prior high, and look at all these tests of this gap support. Here we come back down again. I don't want to close below $20, and we're right on that threat of doing that. And check out the 20-day test here. I think that also is something that you want to be careful of. That's telling me that false breakout and coming back down and closing below that 20 suggests to me that we're probably in a downtrend, and a breakdown below 20 would confirm it. So I would avoid it.
Okay, the next one is actually hitting new highs, SBAC.
Yeah, is this in the REITs?
It's a telecommunications, okay. Wireless.
All right, I thought that maybe it was listed among some of the REITs, or anyway. I like the breakout here. Actually, it is listed with some of the REITs, I think.
Oh, interesting.
But anyway, SBAC had pulled back on big volume. But notice it didn't lose its 50-day moving average. It has been a steady uptrend in a steady uptrend. And when you look at the chart, the relative charts, this is what I like to see. So to me, it's not surprising that with the market going down, you've got a relative outperformer here making a breakout. So this is opposite of the ones I just looked at. I actually think this one looks really good. And any kind of a pullback, maybe to test the breakout level or the rising 20-day moving average, I think would be buyable areas on SBAC. I just want to get this arrow in here on the 20-day, because now that we are breaking out, I would look for that 20-day. If we fail to hold price support, I would look for that rising 20-day to hold. So I think that 208 to 2012, that area would be good accumulation on SBAC.
Very good. Next one is gold miners, GDX.
Yeah, I talked about the gold mining earlier in the show. And yeah, this is clearly in the near term when market is fearful. This is an area of the market that you want to consider. I'm not a big fan of it longer term because, again, I think the dollar is going to play a role here. But I can't argue with the breakout that's taking place here on the chart. So let's draw up a couple of lines here, maybe to watch as we go forward. Because, again, if I've got an area of the market that I really like short term, but for whatever reason, the long term makes me a little nervous, then I think what we have to be careful of is if we start to fail at certain levels. So here was a top back in January. We broke through it, came back down. We held the level, broke down below it. Here we failed again at that level. I think 2150 along with that 50-day moving average has been a key pivot area on this chart over the past 6 months or so. It looks like we're getting a breakout with volume, which is great. Be prepared if we fail. If we come back down later today and we print a tail above resistance and above the 50-day, but close back down toward the low, that would bother me a little bit here. So GDX, I like it short term. I'm not a fan long term because of what I believe I think we're still in a rising dollar. But short term, I could trade it if it manages to break out. But I want to make sure that if it fails to hold that breakout, that I am safely out of it.
Very good. The next one is bellwether retailer Walmart, WMT.
Yeah, this is a bellwether. And I think with what's been going on in retail in general, I think the fact that Walmart's holding up here is tremendous relative strength, at least versus the retailers in general. But you can see relative to its group, it has been declining a little bit. The overall group has been holding up. So that's one of the reasons why Walmart has been holding up. I would simply say this, because it has struggled a little bit relative to its peers. Maybe what we do is keep a fairly tight stop. I'd probably move it all the way up here. This is where we had a top back in March, failed to get through with volume, pulled back, and then we finally made that move up. All of these highs, though, have been coming in around 104. I think we got a tight range here, honestly, Mary Ellen. WMT, to me, 99 to 104 is a fairly tight trading range. Mm-hmm. And let's see which way it breaks. I mean, if we get volume and breakout, that'd be very bullish. But if we don't and we fail and we roll back over, don't lose sight of its relative strength, which has not been great. So I'd keep a stop probably on a close below 99.
Very good. Well, I didn't see Splunk this week, but we do have Funko, FNKO.
Yeah, every week, every Friday, throw one of those at me, don't you? Yeah, the overall group, again, you get into clothing and accessories. It's been horrendous, breaking below the March lows. But notice Funko has not been breaking below the March lows. It's hanging in there. And the volume trends are pretty strong. So what you have is a stock that actually is about a 9-month relative high versus the clothing and accessories group. So you've got a relative winner, but you've got a horrible group. Look at the clothing and accessories rolling over on a relative basis, nearing a 52-week low. I would say if we get the tariffs settled at some point, this is a type of stock that I would look to because it has been showing a lot of relative strength, solid volume trends. But as long as we are in a downtrending group, I think that's going to restrict this company's movement to the upside. So I would avoid it because of the group, not necessarily because of this stock. Overall, a breakthrough 24 or 24 and a quarter would be huge for this stock down the road.
Very good. The next one, Cypress. We talked about it being a buyout candidate. Cypress Semiconductors, CY.
Yeah, and a lot of these semiconductors have been hit so hard of late. The last month, 5, 6 weeks has been rough. But check out Cypress Semiconductor. Now it is, a takeover candidate. They've talked about, the fact that there's a lot of interest in this company. I don't like companies. I don't like buying companies on rumors, because if those rumors prove false, guess what? It's not going to be up here any longer, and it's going to move back to the downside. All you need is for the company management to come out and say, well, we're really not interested in selling. And then you would see a move probably back down toward the low end of this range. So I don't like the reason for the relative strength here. We do see the relative strength. I just think the speculation, I think it creates a little bit more risk than I'm willing to take, because all it's going to take is one news item to come out from management saying we're not interested, and all this breakout, all of this would fall apart. So I think to the downside, I'd watch 15. The breakout's nice, but again, for the reasons I just talked about, I think I'd pass on it.
Very good. The next one is ACIA, Acacia Communications, a Huawei play. They sell to the Chinese telecom company.
Still waiting for the Lime tariff play. Okay, here was your breakout. Big volume back in February, and we are right on this level. I mean, this is, to me, this is the area it's got to hold. It already is downtrending. Volume's been heavy. If you need something to cling to, this is what I would cling to. I think if it doesn't hold $46, when you look at the relative strength beginning to decline again, I would pass. So I'm going to have a really tight stop if I was in it, or if I'm looking to get in it. Now, I would not buy a stock like this. Trending like I just need to see relative strength. I need to see a movement back through the 20-day. I need something positive. I'm not going to try and bottom fish. I don't like doing that. I'm just suggesting if you're in it, maybe you take a look at this price support level and just say, okay, I'm down here already. Let's see whether or not we can hold here.
Very good. The next one is Quest Diagnostics, DGX.
All right, DGX. I do like the volume here on this move to the upside. It is beginning to show some nice relative, well, it has been showing nice relative strength versus the healthcare providers group, but the healthcare providers group's been in this downtrend. The last 6 weeks or so, though, the group has been outperforming. I think you could maybe make an argument for the stock based on the way it is performing over the last 6 weeks relative to its group, and the way its group has been performing on a relative basis. So I'm okay. This is one that's starting to turn around. I would probably just make sure I keep my stop in play. I think right there you've got it should have some pretty good support, because after this huge move up on volume, the first bit of selling took us back down to about $93. That's where our 50-day moving average is. Want to give it a little bit more room, maybe that breakout there around 91.5. But this is a pretty good zone where I'd be looking for a reversal if it pulls back a little further. Keep in mind, earlier this month, it was up close to 199.5 or so. So if you can get this back in the 92, 93 range, I think that reward risk would set up pretty nicely on a stock that's beginning to show some outperforming characteristics.
And the last one is a not very fit stock. FIT is the ticker symbol.
All right, FIT. The Fitbit.
Mm-hmm.
Yeah, not looking good here. In recreational products, you can see the overall group has had a rough month in May. And when you look at the relative charts, and again, I pay so much attention to this. When I look at this, I don't even need to look at the chart of what's going on with Fitbit. When I see this, it's in an underperforming group, and it's an underperforming stock within the group. I don't need to look at the chart. I'm not interested. Again, I'm not going to try and catch an exact bottom. If that's your style and you like the stock and you think that, from a valuation standpoint, it's something you'd be interested in, then maybe take a look at a couple of these support levels. But when I see this downtrend in play, heavier volume and relative weakness across the board, I'm just not interested. So I personally would pass on Fitbit at this point. And that is the final 10 and 10 stock. So
very good.
Hopefully you agreed with me on some of these, probably disagreed. Did you see any, Mary Ellen? I don't know if you were following along there, but
absolutely.
I mean, did you disagree with any of those? Would you have?
No, I agree. I mean, that CRM is one I've been watching. I've had it on my list a couple of months ago, but once it started not participating with the rest of the group, I bailed, and it's still struggling. So that was one that really struck with me. And your comments about Cyprus were very good as far as one headline away from losing their recent big shift uptrend here.
Yeah, I'm not a big fan of playing stocks that are, where there's a lot of speculation. So
Mm-hmm.
anyhow, there are the 10 stocks that we just went over. They'll be posted in the Market Watchers blog later today. And we'll be right back after this message.
Market direction is the single most important thing all investors need to know. Get the advice you need by joining dozens of elite money managers and financial experts, including Steve Forbes, Paul Merriman, Tom McClellan, and Keith Fitzgerald at the Money Show Seattle June 15th and 16th. You'll hear real-time market analysis and learn which stocks, bonds, funds, and commodities you should buy and sell to build a safer, more profitable portfolio. Claim your free pass at seattlemoneyshow.com.
Okay, welcome back, everybody. Let's take a look at our final market update. You can see the Dow Jones Industrial Average. We saw the market starting to make a recovery just before we began the show, but really over the last hour and a half or so, we have begun downtrending again. I don't like ending a week, and especially, any day. I don't like the afternoon selling. I'd like to see some accumulation taking place in the afternoon. So the next few hours, I think, are going to be kind of important. It's hard to say what's going to happen over the weekend. Is Mexico going to come back and retaliate? Is China going to come up with something? So I'm just not a fan of seeing the market start to turn back and roll over again. Let's see whether or not we can hold those earlier lows from the first half hour this morning. As far as some of the stocks that I like to follow, I like following these scooters. And so when you set this up, and just to point out to everybody here on the this gear shift, you can go in here and make sure that you have your additional data panels checked. And if you do, then those three panels will show up for you. The three I'm looking at here, technical rankings. And I just set them up so that I have large cap scooters, mid cap scooters, and small cap scooters. And a lot of times during the day, I'll just simply take a look at what's going on. Top 10 will tell me the best stocks, best large cap stocks based on scooter rank. And then if you go across here, you got the low 10, the top 10 movers in scooter rank today, and then the bottom 10 movers. So you can see, for instance, SYY getting hit. Kansas City Southern. This is one that I actually liked a lot in the railroad space. But when you start having tariffs with, Mexico, all of a sudden the railroads become impacted. They weren't so much with China, but now we're talking about North America. And so you've got some of the railroads getting hit today. But just simply scrolling down here and taking a look can give you a lot of great ideas. So just wanted to point that out. As far as the sectors go today, take a quick look at this, see if anything's changed. We still have leadership coming in from real estate, utilities. To the downside, still consumer staples and communication services. So nothing really has changed much from when we did the update about an hour or so ago. Also want to make sure you are aware that you can change the period here. So that if you want to say, okay, the market's had a rough week, what's been leading and what's been lagging, just pull up the 1 week. When we do the what's hot, what's not, actually, I work right off of this. Real estate, you can see, has had a pretty good week on a relative basis. Energy, not so good. And if you then go to the or one of the areas, let's say, okay, I want to focus on energy, you just simply pull that up and you can see coal, not a very good week, oil equipment, exploration and production, not good, but renewable energy, which has been one of the best areas of the market. Let me show you a 6-month chart here. Renewable energy is up 39% the last 6 months. We're getting this big pullback. You'd think, okay, all these stocks that are, have all these profits are going to pull back. They're actually still leading in a weak market. So renewable energy is a solid area to take a look at. But anyway, I just want to point some of that out. I am going to move into seasonality. I do want to go through a number of areas of seasonality. So first, let me start with, and this is going to be a look at June. And so what the market tends to do in June. These are not guarantees. Please don't misinterpret any of this. This is tendencies, it's probabilities, it's being informed and helping to make informed trading or investing decisions. So if I'll just for now go out and take a look at the, I'm going to focus on small caps. So let's pull up the Russell 2000. You can look at this chart while I go through and tell you some of the things maybe we can look for in June. First of all, on the S&P 500, since 1950, June has risen 36 times and it's fallen 33 times. So it's almost a 50-50 proposition. June is not a good month for equities, especially the S&P 500. It has produced an annualized return of 0.15%, dating back to 1950 during the month of June, and that ranks 10th out of the 12 calendar months. I'm pretty sure that August and September are the two that are worse. The NASDAQ since 1971, so we're going back almost 5 decades. June has gone up 26 times. It's gone down 22. So again, just a little bit better than 50-50. Annualized return on the NASDAQ over those 48 years, 7.74%. That ranks 9th out of the 12 calendar months. And then finally, the Russell 2000. The Russell 2000 has risen, this is since 1987. The Russell 2000's risen 19 times, and it's fallen 12 times. So the odds of the Russell 2000 going higher are better than what we see on the S&P 500 and the NASDAQ. The annualized return for June on the Russell 2000, just 4.5%, 4.57%, which ranks 8th of the 12 months. But when we start talking about relative strength, and here you can go in and just select seasonality. Anytime you want to check out the history going back the last couple of decades, just go into the seasonality. And first, I'm going to pull up the Russell 2000. And you're going to look at this and say, well, what seasonality? I don't see any strength. June's gone up 63% of the time in the last 20 years. It averages going up 0.6% over these last 20 years. Not exactly a, confirming signal to put all your eggs in the small cap basket. That's for sure. But when you consider relative strength, and this is where I'm going to pull up the S&P 500. Remember, Russell 2000 averaged over the last 20 years, gaining 0.6%. S&P 500 actually averages losing 1% in the month of June. So plus 0.6% for small caps, minus 1% for the Russell 2000. So by simple math, that should mean that the Russell 2000 outperforms by an average of 1.6%. per month. And when I drag this back 20 years, check that out, 1.6%. And look at the 84%. Now, what this is telling us is that over the last 2 decades, the Russell 2000 has gone up at more, or actually, I shouldn't say that. Doesn't necessarily mean it's gone up. The Russell 2000 has outperformed the S&P 500 84% of the Junes over the last 2 decades. And if you drag this, I can show you. All right. So first of all, we haven't had June yet. So we can't, from June through December of 2019, obviously it's not showing anything. But let's drag it back. So here is last year. We outperformed by 0.1%. Go back to next year, still 100% in June. By the way, June is the only month over the last 2 years that we have seen outperformance by the small caps each of the years. Keep going. Fourth year, okay, now we're down to 67, so it's 2 out of 3. But as we scroll back, now we're 3 out of 4, 4 out of 5, 5 of the last 6, 6 of the last 7, and then 6 of the last 8, 6 of the last 9, 7 of the last 10, 8 of the last 11, 9 of the last 12, 10 out of 13, 11 out of 14, 12 out of 15, 13 out of 16, 14 out of 17, 15 out of 18, and 16 out of 19. So 16 of the last 19 years, the Russell 2000 has outperformed the S&P 500, and the average outperformance is 1.6%. That is enough history for me to at least consider reallocating in June and having a little bit more maybe skewed toward small caps, maybe a little less toward the large caps. Is this a guarantee? Of course not. We just said 16 out of 19 years. That's not 100%. But the probabilities are that we're going to see outperformance by small caps. So with that in mind, let's take a look at this Russell 2000 chart. And I'm going to go let's look at a longer term weekly chart. Obviously, the daily doesn't look good. The daily doesn't look good across most areas of the market. I see, and I'm going to go back even further. Let's go back throughout this bull market. And so when you take a look at the bull market and we annotate this, just keep in mind that these major lows that we have seen, you can draw a line right to them. Pretty interesting. I mean, it connects almost beautifully here with the closes. These are weekly closes. So the close back in October 2011 lines up with early 2016 and then December of 2018. Those major lows have established this uptrend. And then what I can do is just drag this line and potentially connect highs. So if we were to go out quite a ways, I could see, I mean, based on this longer term bull market, if we stay in it, take a look at where the Russell 2000 is relative to trendline support versus where it would be versus trendline resistance. And I can start to make the argument that this weakness, we should begin accumulating small cap stocks. The other thing I'll say before we get into looking at individual areas of the market is that had my train of thought here. Just lost it. I'll come back to it. But what I did want to point out with the Russell 2000, and I'll go back to a daily chart. You can just look at the chart, but I wanted to point out some of the times of the month when the small caps tend to perform really well. June 1st to June 5th is very bullish. Of course, today's the 31st, so we're talking about next Monday through Wednesday. Annualized return since 1987, June 1st to June 5th, 54.05% positive. I mean, that's pretty significant gains that we tend to see in the small caps. As far as the chance of any individual day going higher, 63.3% of the time, days that fall June 1st to June 5th, 63.3% of those days have been higher. So 36.7% have been lower. So you've got a much better chance of an individual day going higher in the early part of June. June 6th to the 12th is more of a bearish period. Annualized return, Russell 2000 during those days since 1987, minus 32.57%, and only about 48.5% chance that an individual day will move higher. 13th to the 17th, back into a bullish period, 26.82% annualized return for the 13th to the 17th of June on the Russell 2000 since 1987. And during that period, 56.25% chance of any particular day moving higher. 18th to the 25th, and this lines up beautifully with just about every month. 18th to the 25th tends to be a very bearish part of, or very bearish time of most calendar months. In June, no exception. Minus 45.09% annualized return during that week. 42.61% chance of any particular day going higher. And then you go into the end of the month, the last 5 days, the 26th through the 30th, and 64.99% is the annualized return. The chance of an individual day going higher, 61.95%. So not every day in the calendar month is created equal. I think I've gone over that during many calendar months. So hopefully you do understand that at least longer term, and I mean, I've got a ton of days that support this theory. The 26th to about the 5th or the 6th of calendar months tends to be very strong. The 7th to the 10th, not so much. The 11th to the 18th, bullish. 19th to the 25th, bearish. 26th again starts it over again. So these June numbers, not exact, but they tend to follow what happens throughout most calendar months. Okay, so let's say the Russell 2000 is an area we want to focus on. What sectors do we want to consider? Well, I wanted to pull up a couple of here because, first of all, financials and industrials don't tend to do very well in the month of June. But when I looked at the small cap industrial index or ETF, it is right on that March support. So I don't know. I mean, this would be an area you wouldn't have to give a whole lot of room to the downside if you wanted to play an ETF, small cap ETF on the industrials. We're right at support. Also, financials holding support so far. We do have a little bit more downside action to get down to the March low. But this is another one that's been under pressure this month, but getting close. But I'm going to focus a little bit on the healthcare group, because not only do we see the PSCH, which is the small cap healthcare ETF, potentially putting in a reversal today at the at the April low. But when we look at the XLV, I'm going to go back into the seasonality here. When I pull up the XLV and compare it to the S&P 500 and drag this back, look at June. 79% of the time, healthcare outperforms the S&P 500 during June's, and by an average of 1%. And when you look across here, that is outside of January, that is the best relative performance of any month. And the odds are actually greater in June than they are in January. So I think, number one, we've got to at least be considering small caps based on seasonality and healthcare. So then I say, okay, well, what am I going to do with that? Small cap healthcare. Well, what I did with it was, if you go back to your dashboard and go into scooter reports, we can pull up the highest scooter scores for small caps, and I can type in healthcare. And now it's going to list all of the healthcare stocks in scooter order. And then I kind of look down. For the most part, there were a couple of biotechs that I'm going to go over individual stocks. But for the most part, these biotechs are small companies that can be really easily manipulated. Some of them don't have a lot of volume. Some do. But they also can have an announcement that just comes out of the blue regarding a product. And so I would be careful getting too aggressive on small cap biotech stocks. I don't think that's a great way to make money. It can be for a day or two, and then you might give it right back or maybe get hit hard with the stock. So I would just be careful. So as I go through these, there are a couple biotechs that I'm going to bring up. But for the most part, I was skipping through the biotechs and looking at the high scooter ranked healthcare stocks that are outside of biotechs. The other thing is biotechs, they do love the summer months, but they're not performing well technically yet. So I'd like to see that change before I get too excited about the biotech stocks. So let's take a look at some of these stocks. And so here is the seasonality. All you have to do is click on seasonality here for an individual stock, and you can pull it up. So MDXG, you can see over the last 13 years, May and June have been very strong. Maybe not on a percentage basis of going higher, but look at those returns. February, 137%. That had to have been like an IPO or maybe an announcement of a product. I'm trying to see if I can grab that. See, yeah, that was back in basically its first year. So it must have been because of the IPO when it came out. But anyway, the May and June average returns are pretty solid. December, clearly, I would say is probably the best month based on percentage moving higher in the month and the average returns. But May and June, pretty good. So when I look at MDXG, I would then go in and pull up a chart. And you can see the stock just made a breakout. So I would be using not just seasonality, but then I would say, okay, this is one I want to consider. Let me look at the chart and see if the chart looks good. Because if the chart looks good, and I think small caps are going to outperform, and I think healthcare is going to outperform, and I got a stock that's breaking out, and it has great seasonality, now I'm starting to line up a lot of different things that would suggest maybe this is a stock I want to be considering as we go forward. Just something to be considering. All right. Let me see here. Next up is, got my list here. Actually, let's go back to that scooter listing here. So small cap healthcare stocks. I won't keep coming back to this. I just wanted to show you how I go through and pull some of these up. I think Tandem Diabetes is one maybe to give some serious consideration to. It doesn't have a long track record, but look at over the last 7 years. 80% of the time it goes higher. Average is going higher 12.5% per year. For June, the average return in June, the last 7 years, 12.5%. So this is a stock that I certainly would be considering. EPZM, I'm just going to stay on here. All right, EPZM, May and June. Look at that. Again, only 7 years, so not a lot of history. I prefer 20. I like being able to go back 20 years and see the history go back and be confirmed by a longer period of time. But you can see May and June have been very strong. And so once again, if I pull up the chart, you can see that it is trying to make a breakout. So I would be watching to see if we can get this breakout. And I don't know. I mean, Mary Ellen, I'm going through a lot of these stocks and a lot of these different areas of the market. But do you find that seasonality, you use it much in your trading or the way you look at the market, or is it strictly based on technicals?
Yeah, I don't. I may, after watching you in action here, put a little more weight there. And I was going to mention with that Tandem, for instance, TNDM that you pulled up, they came out with great numbers 2 weeks ago. They do insulin pumps, and they're coming out with a lot of new devices that they are going to be introducing. This was a big winner last year, and I really like that scooter. That scooter rating I'm a fan. I love it because I do a lot of screening, and then I'll go over to the scooter, and there they are. The most technically attractive stocks are listed up there in the forefront. So that was one. And the other company you mentioned, they actually are up 40% this week, MDXG, and that's because they're reshuffling their board of directors. So that might be worth having in the back of your mind when looking at it, but certainly breaking out of a base. And
yeah, that's actually a very good point. And I would, when I see something like this and a huge move like that on the daily chart yesterday, that was a massive move and heavy volume. First thing I would do is go look for the news. I would want to see, okay, was that earnings related? And as you're mentioning, it's a reshuffling of the board. That it could have an impact on the business longer term, but that's the type of thing that doesn't get me overly excited. I would rather have the fundamentals, knowing that a company is executing its business plan rather than shuffling management or board of directors, that sort of thing. Okay, let's go ahead. We still got a bunch here, or a few stocks I want to point out. This one is a biotech, by the way, VCYT, and the stock's getting hit today. But if we take a look at the seasonality on the stock, and you can do this, I just wanted to show you down at the bottom of any chart that you're looking at, you can always go down the bottom of the page and just click on the seasonality down here. Another way to get to it. But if I drag it out, look at June, 80% of the time in June, it goes higher over the last 7 years. An average return in June, 6.9%. So not having a great day today, but if it reverses or you start to see something technically that you find appealing, just keep in mind this is a small healthcare stock that does love the month of June. Next up, Fluidigm, FLDM. This was a stock that I actually liked for quite a while. They went down with their last earnings report, I believe. But 75% of the time it does go up in June. And it's not nearly as strong seasonally as some of the others. But I was looking at the chart. When I get these moves back up above the 20-day moving average, that tells me that maybe this push to the downside was simply consolidation after a huge move to the upside. This stock was $7 back at the end of 2018, ran up to 15. It was more than a double in 2.5 months. So it makes sense that the stock, even though it broke down short term, maybe just needed a period of consolidation. And that's what this is starting to confirm to me. So I just wanted to point that out. Along with not so bad seasonality, we've got a stock that's been a leader early in 2019 that seems to be regaining some of its relative strength. Next up, PODD. And this is Insulet Corp. Another stock, looks really good here. Nice volume. See that breakout with the heavy volume, pulling back, nice little hammer, continuing to move up. I think this stock looks good. And if we pull up the seasonality on PODD, looking at the last 5 years, you can see obviously average of 6%. Let's drag it all the way back. Last 13 years, it's gone up 75% of the time in June. Average is going up 5.1% during this month alone, and that is third only to August's average return and December's. So nice upcoming seasonal month for PODD, and also the chart doesn't look bad either. NTRA. Many of these small companies, by the way, don't have long track records. I found most of them did not go back 20 years. But over the last 5 years, it was hard for me to ignore the average gains the stock has had in May and June. Average of more than 20% in May and an average of 18% in June. And when I looked at the chart, can't really argue with what's going on here. Nice breakout above this prior high. These pullbacks have been holding support, trading above the 20-day. So we're already seeing relative strength here in a group that tends to perform really well in the month of June. And the stock tends to perform very well in the month of June. So NTRA I thought was worth mentioning. EXAS, this is another biotech. First, I'll look at the chart, and you can see it's having a really nice week, even though the market's been struggling. And it's not far from a breakout. Let's watch this 105 level, because from a seasonal perspective, it does like the month of June. The last 19 years, it's averaged going up 11.4% during the month of June. And we are on the verge of a breakout. I'd want to see that breakout first. But if we do get the breakout and the technicals look good, this to me confirms from a seasonal perspective that EXAS could be a great one. And then I'm just going to do one more here. And the reason I'm going to do this one looks good to me both seasonally and on the chart. It's had a, whoops, wrong one. It's had a pullback here, and there we go. It's had a pullback on its chart, which I like. But here, last 10 years, it's gone up 78% of the time, June, and you can see 4.5% average return in June. And then finally, we'll bring that chart up. See this move up, taking out prior highs? The move accompanied by heavy volume. 2 days ago, look at that hammer. Beautiful, coming right back down to price support. I think we're simply consolidating great volume trends. Stock loves June. It's in the healthcare area, one to consider. So that is essentially what I had. I will say that June is typically not a great month for areas like technology, industrials, financials. I talked about those areas. But those tend to be underperforming areas of the market in June. So something to at least consider.
And there might... Oh.
Go ahead.
I was going to say there might be one other reason these healthcare stocks tend to do better into June. There are a couple of really large institutional conferences that are taking place, healthcare conferences and growth stock conferences. Jefferies is in June 4th. William Blair has their conference June 5th, and then Goldman Sachs has their healthcare conference June 11th. Sometimes you'll see that where these institutions are listening to management, they like what they hear, and they get in on some of these stocks.
That is an excellent point. Very, very excellent. No doubt about it. Okay, well, we're going to move on, wrap up the show here with our poll, talking about Chart School. And 5%'s never used Chart School. You should definitely go in. Arthur Hill's done a tremendous job with his contributions, that part of the website. So you definitely want to check that out. But looking at this, 36% say they go in maybe monthly, 27% weekly. 21% a couple times, here or there, just checking up on something. 12%, so about 1 out of 8 of you have go in there every day. I think it's a great, fascinating, and free part of the website. What about you, Mary Ellen? Do you go in there?
I do, actually. I'll come upon something and just wonder, well, what exactly is that telling me? And it's a wonderful resource.
Yep, no doubt about it. I do use it from time to time as well. And if you want to know something about the scooter or whatever, go in, type in the scooter, look at Chart School articles, and great way to improve your technical skills. Anyhow, I want to thank all of you for being with us today. Please remember to complete the survey as you exit. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays, from noon to 1:30 p.m. Eastern Standard Time. Have a great Friday afternoon, everybody. Have a great weekend. And don't forget those Coronas and limes. We'll see you back here on Monday. Happy trading.